Welcome to Edison TV. I'm Catherine Thompson, Technology Analyst at Edison, and I'm here today with Kit Kyte, CEO of AIM-listed software company Checkit. Welcome, Kit.
Thanks, Catherine. Thanks for having me on.
For those who don't already know Checkit, could you give us a brief overview of the company and what problems is your software seeking to solve?
Yeah, sure. So Checkit's a technology company. We do IoT, Internet of Things, and software as an integrated platform. So the Checkit focus is exclusively on what we call the deskless worker. So that is the majority of employees and workers globally, about 80% of the global workforce. And these are employees who work for very large blue chip, multinational, multi-site organizations. They have to do a lot of work, a lot of tasks, a lot of activities. The Checkit platform gives them a digital solution, a workflow solution to manage the work that they do in real time. And because they work in built environments with a lot of fixed assets, a lot of critical assets that are looking after critical goods. For example, if you're thinking the healthcare industries, the biotech industries, vaccines, blood plasmas, our Internet of Things sensor ecosystem provides an automated monitoring solution for all of those assets, integrating back into what we call the Checkit Cloud platform. So that then allows the removal of mundane activity, the removal of human error from the monitoring of assets, and it frees up workers to do higher value activity. That is the core of what Checkit does. Of course, what we do is we generate a lot of data by monitoring all these different points, and we present that management information to senior operational leaders, senior compliance people, in order to help them make much more effective business decisions. And that's really the essence of Checkit. So we drive efficiency into an organization. We help them drive some cost out, but at the same time, we are a compliance and a safety and a sort of last line of defense system for mission critical operations.
And you recently reported your FY24 results. Can you run us through the main highlights?
Yeah, sure. Again, a solid year of growth. You know, we have two twin goals here, one of which is to maintain sustainable growth rates, and the other is to accelerate our path to profitability. So from a growth perspective, we hit 16% growth in our ARR to £13.3 million. Revenue is up 17% as well. That has meant that our compounded recurring revenue growth of nearly 30%, or just over 30% since FY20. Losses were also halved at the same point, down to 3.4 million for the year compared to 6.4 million the previous year, so which we're very happy with. And we also grew gross margins up to 67%. So that's a 4 percentage points increase that kind of gives you an indication of the operational leverage that's starting to come through in the business. Pleasingly, a couple of our core metrics that we really think about. So our net revenue retention rate was at 111%, which is top quartile, and again is further evidence of the land and expand strategy coming through. And equally, our churn rate, so gross revenue retention, was best in class, really at 99%. So keeping hold of customers for longer as we then look to grow them. Cash finished the year at £9 million, so we're well positioned as we drive through to profitability. And I think that that identifies a year that was well delivered. And we've recently launched a new product capability called Asset Intelligence, which I think we can speak on a bit more down the line, which is effectively our machine learning and AI capability being brought onto the vast amounts of data that we run.
Great. So actually, to touch on that, you previously talked about the high volumes of data that customers generate using your platform, and a module that you recently announced, Asset Intelligence, is looking to kind of harness that. Can you explain how it works and what kind of reception you've had from customers so far?
Yes. So it's correct. Vast amounts of data is generated through the Checkit platform. It sits inside our cloud ecosystem. And I think it's one of the great advantages, one of the points of difference that Checkit has, the ability to then use and build our own proprietary tools on that data in order to enhance not just customer efficiency and effectiveness, but actually the stickiness of the value of the products as a whole. So with Asset Intelligence, what we realized is that inside the customer's built environment, they have hundreds and thousands of these fixed assets, critical assets that are being monitored. what we're able to do using the data that's already being provided and running the right algorithms on top of it is we can help customers in 3 areas. We can give them real-time predictive maintenance insight. So we can give them a high degree of likelihood and probability around when a particular asset is likely to fail. This is very important because you can get in and take a preventative action, which of course helps them save on wasted stock, compliance challenges, but also increases revenue uptime for them, right? You can't sell ice creams if the fridge has gone down and all the ice creams have melted, right? On a very simple level. And you can apply that to much more higher margin industries or higher margin use cases to see the benefit. So predictive maintenance. The other one is really around ESG. So this is around energy cost savings. So again, just by taking the data around temperature fluctuations within a certain asset, we can baseline and predict what the optimal range is supposed to be, and then which assets across an entire fleet of hundreds of thousands of locations are significantly deviating out of those ranges. Every time they're deviating out of those ranges, they're burning more energy than a customer should be burning. So it's not just a cost saving for the customer by helping them take corrective actions on that. It also feeds directly into a more effective and sustainable ESG play. And then the third thing that we help with, which is related to the previous two, is asset swap out measures. So again, these organizations are typically flying blind. They don't know which assets are already offline or gone offline. And so as a result, they tend to replace stock on a very kind of ad hoc, brute force manner. Okay, this is clearly inefficient. If you decide from a maintenance perspective, you're just going to replace 10% of your assets every year, regardless of whether that's what actually needs replacing. So our ability for them to be specifically target how many assets will need replacing makes this a very valuable proposition. So that is the essence of what our algorithms are able to do on the data that we're already providing. Okay, so that's the value proposition here. It's quite compelling. Customer reaction has been significant. There hasn't been a customer I've met who haven't wanted to have this kind of capability brought to bear. So again, if you think about healthcare customers or biotech customers, the cost of the assets and the machinery that looks after very expensive goods is significant because they have to be, they have to be capable of delivering results to a very fine range. Their perennial problem is we don't have any idea when this stuff's going to go down. So when you mention this, and we've mentioned it to them in meetings and they're very receptive, more often than not, they're actually bringing it up before we've had a chance to mention it. Is this something you could do? So it's quite pleasing when you invest in innovation that customers are actually bringing it to you without you having to necessarily bring it to them. So that's a good example. And I would say that we've just launched the product, so it's been fully productized. We've had it in beta with 4 or 5 customers with very, very strong and positive results. We've just launched it as a fully fledged product, so we would expect to be able to roll this out through upsell, cross-sell across the existing customer base as the year goes on. And I imagine that also when we think about net new customers, this will either be an additional product line that can be upsold to a customer, or it will be part of a very sticky, differentiated package that gets us in the first place. And we'll see how that goes.
You previously talked about wanting to generate at least half of your business from the US. Could you give us an update on progress there?
Yes. Well, I'm speaking to you from the US. I've been here all year so far, and that's very specific to your point. The US remains the single greatest market opportunity for Checkit. The commonality of the blue chip customers, as we have in Western Europe, suggests really, really significant expansion opportunity if we can get our hands around it and be focused. Obviously, the US is a highly competitive place, so you need to, many UK companies come a cropper in the US. So we are, the measures we've taken is to increase the sales leadership and the sort of go-to-market footprint in the US on an incremental basis, but very specific around the industries we focus in. So healthcare, food, retail, hospitality only. But what I'm seeing since I've been out here in terms of the pipeline generation perspective is there's an uptick in the size of deals that are now coming into our pipeline, US focused, and the decision-making timeline around some of those opportunities as compared to, say, Western Europe, which seems to be more protracted and longer. So it's quite encouraging that the US market is receptive to what Checkit can bring. from a product and a value prop perspective, and they seem to want to be able to do business a bit quicker. We will see how the year pans out, but those are the indications I've seen since I've been out here.
Actually, touching on a point you just made about the length of sales cycles, I know that you previously commented that the tough trading environment had lengthened them. What are you currently seeing there? And is there any kind of cause for optimism from any of your customers, existing or potential?
Yeah, I mean, I think for larger opportunities with the really big blue chips, you're still seeing a long and protracted sales cycle, and I don't think it's anything other than a reflection of an element of risk that large corporations have now onboarded in terms of how and when they make decisions. They're still doing it, but they've just slowed everything down. So that I think those parameters remain. Interestingly enough, we have started to see, and this is even in the UK, an uptick or a slight uptick in the hospitality kind of food retail space, where that's, as you know, that's been really on its knees for the last couple of years. Too early to tell whether that is a result of better trading on the street, whether it's as a result of other economic factors such as yet another increase in the minimum wage, which is going to be putting real stress on their business models. But our pipeline has started to see a number of previous pursuits that had been put on the back burner come back online. So that's good to see. What I do notice is that the higher the margin industry, the shorter the sales cycle, which would make sense. So for us, if you think about the healthcare industry, which is very large, obviously we've got a bunch of subsectors in there, that's about 50% of our ARR now. And we do see that is more robust in terms of sales cycle, willingness to sign contracts, commitment behind that additional scope, upsell. So that's still coming through more strongly than, for example, food retail or hospitality, which is lagging.
Great. And finally, could you comment on outlook for the coming year and also your targets to break even?
From a break-even perspective, and as the analysts and the guidance that's in the market will show, and as we've just demonstrated in our annual results review, the level of cash burn year on year has been reduced significantly. We are managing our cash position such that we would expect to hit cash flow break even in around about Q4 of FY26. We're in FY25 now, and it fully EBITDA break even by FY27. So for those that don't know, that's pretty much by the end of calendar year 26. So we were about a couple of years away at best. So really solid progress. We are not concerned about our ability to have cash to take us through this. In fact, we're optimistic when we see the operational gearing starting to come through and the sales cycles that are in play, that actually we can continue to deliver on this plan. So as a whole, the board is confident for the year ahead. We've made some encouraging early progress with certain customers and bits of contract news that we've released recently to the RNS. And yeah, we look forward to the remainder of the year with confidence.
Great. Thanks for the update, Kit.
Thank you.